video, we're going to add financing to the generation analysis. Right now, the model is set up so you can look at different power plants and look at the price of electricity. This is in either US or Naira per megawatt hour. This should say price for electricity per megawatt hour. Why don't we just put real price of electricity? So we're comparing the cost of different technologies. We're including a diesel unit and a petrol unit, as well as a combined cycle and combustion turbine unit. We show the various components of the cost, and what we have done is say, okay, if you want a real IRR, not a nominal IRR, a real after-tax IRR of 7%, then we put this in. Now, I think, on the first thing, why don't we make this, because let's see where we entered this. We put an after-tax IRR here of 7%, and why don't we allow for this to be adjusted? Now, if you want to put in a sensitivity analysis around a variable like this, we can go to the Developer tab, Insert, put a little button in. Now this is going to be a percentage one, so we're going to have to go to our format control. Let's do this since it's a percent. Let's make it go from 0 to 100. Even though you'll never go back above 100, we do our windscreen wiper method. We get our little button here. I'm gonna make it like this. Let's make this equal to this number divided by 1,000. How's that? I just made it. I said 1,000. Okay. So we can, and why don't we make this, instead of stopping at 100, let's make it stop at 500. That would be, I assume that we can go way up or way down. Now if we copy this and put this next to our real IRR, now we can change this. IPP financial model F40. Let's put this. I think this should be called the target. Let's make it. Come on. Let's make the target IR. Okay. Perhaps I'll put this one over here. And perhaps we'll make it smaller to be more consistent with the other spinner boxes. Now when I change this, then we can get the, well, that's interesting. It should have, why? It didn't give us the exact IR. Okay, the reason the goal-seek wasn't working, that was a good little check. We have to go to the formulas, and look at this. Let's add an element of precision. Now when we do this, and let's check change the target IRR and we get a different capacity charge. Okay, so there's a little sensitivity analysis in here. Now, the one item we haven't computed in this part of the analysis is the equity IRR. I think we can also then, once we put the given capacity charge up here, this is the given price of electricity, and with the capacity charge. Now I think I'm going to move the capacity charge right up here, because that's such a central part of what we're really looking at. And I suppose we could do this, divide by the EX rate. Okay, so that's our capacity charge per kilowatt per month. This is in really Nairas, and why don't we put per kilowatt per month? So this is 30 US and 4,908 Naira, and we can do all of our analysis and put the little spinner boxes in, do an analysis on what happens if we change the heat rate. Okay, and do this. Let's make this for an open cycle unit. What happens if we change the heat rate? What happens to the IRR? All right. Okay. That's what we've done. We've gotten all the operation sort of analysis into this. It's really driven by we can either fix the capacity charge or vary it. You know what? Probably we should do is put another spinner box around the capacity charge just to get our models begin. But you know, we can't do it like this. We can't just put, because we've got the other assumptions in here. So what we did here in developing the various different assumptions, we put them in for the different cases. These are inputs, they're in blue. These are the capacity charges, and they're computed from that goal-seek macro we just looked at. And then the way this index works is we take G46. Oops. Oh no. G46, which, come on, I'm pressing F1 instead of F2. I've got it. Okay, I just pressed F3. F46, this is the plant code. This is the big one. Okay, in fact, yeah, well, let's make it bold. This is the thing that really drives all of the index button. If you remember, this whole thing is driven by an index. Now, what we could do is we could, instead of just making this equal, we could put a sensitivity analysis just the way we did before. This time, you know, if you right-click on this button, and instead of P62, this, the way I think it is 64. So now if I change this to 1, 2, or 3, this thing should be this number divided by 100. Okay, for some reason I didn't do it with these. I hope that that's not going to mess everything up. Whoops. Okay, and then we can make this number, which is the final number, the number we get from the index, and we can multiply that by the percentage. Okay, so we put the percentage up and down, and now we can also copy this little thing into the capacity charge. So we can now what we can do is either manually increase the capacity charge. Let's see that. Okay, or we can change the target IRR, and maybe I should leave it to be 7 because I think this was in the multi-year tariff option thing. So we get a capacity charge that's input. Let's put a input message, capacity charge. And this can come from the goal seek or the inputs. Okay, that's not a great description. And now let's finally look at our, so once we have our generation assumptions here, and let's, why don't we, I was going to format those, but we'll do that later. We have some plant by plant assumptions, and then some general assumptions, and now why don't we put some financing assumptions. Now, the key behind the financing assumptions is to keep these separate from the other assumptions, and let's start with the debt sizing. Okay, and why don't we, for the debt sizing, put debt to capital, debt to construction. Okay, and let's make that a percent. And how about we'll make it 70%. So we essentially use 70% gearing. It's a little bit not quite that because interest during construction can be part of this. So we first put debt sizing, and we can also put the target, the ESCR, but I'm going to leave that out. Now after we put the debt sizing in, I think once we figured out how big the debt sizing is, let's put debt funding, and let's put that as pro rata, which means we funded over the same period. Okay, we could also put equity, oops, excuse me, this is really bad. I'm having a bad day. Okay, and now let's, after we put the in the debt funding, let's put the let's make this true. And let's make this not this one, so we can put two different kinds of debt funding in. And after we put the debt funding in, let's put the debt repayment, because after we figure out, we determine how big the debt should be, then we determine how we borrow it, and then we determine how we repay it. Let's put a debt tenor. And now this is kind of the problem in Africa, is that these tenors tend to be fairly short. And let's put the repayment type, and let's call that a level repayment. Okay, we really should have put a little switch in there. And finally, let's put the interest rate. And we should really distinguish whether this is in Naira or dollars, and in real terms or nominal terms, when we did our analysis. if you look at how we did our analysis, we put Naira per kilowatt per month, and then we put the capacity revenues in Naira, and then we put the outage revenues in, and we computed the revenues on a per megawatt hour basis. And then we put in the capacity factor and got how much generation there are. And we put the gas price in both US and Naira, but when we put the revenues in, we put them in millions of Naira. Variable O&M and fixed O&M were in millions of Naira again. And this was the revenue components, excuse me. This was the expense components, and then we had depreciation all in Naira, and we got up to essentially the project IRR. So let's put our interest rate in Naira. I think we already put a debt cost here. A Naira debt cost of which is extremely high, but let's put that in of, my God, 24%. Well, part of that's, of course, that 24%, well, in US dollars would be about 11%, which is still very, very high. That's what we have. And then we could put some fees in, but we're going to keep this fairly simple. Just here's how we're going to put our debt sizing, how we borrow it, how we repay it. Shift Control C to what happened when I pressed Shift Control C? It looked like it was okay. That colors the inputs. Okay. Then, if you remember the way we structured the model, we go to the top. One of the very important things with any of these models is right at the top to put in a time switch. And actually, I think this will be a good review of the model because I'm going to take the freeze payment out, and let's put debt repayment phase, which we begin, and let's put years, and let's get what our debt tenor is. Our debt tenor was 7. Now I think what we should do is when these items come from another sheet, we should color them differently, but for now we're going to make sure that this number is number 1 greater than 0, and this code number is less than or equal to the debt repayment. Okay. Alright, and then we can copy that across, and there are our 7 years of debt repayment. So the first thing about putting in the debt, we need to remember how to adjust the switches. Okay, now we put in capital expenditure, pre-tax cash flow, and so on and so forth. To enter the debt, we have a few adjustments to make. And so this exercise is really taking a cash flow and making it into a project finance model. Now the various sections of the model I would enter, I would start with our debt, funding, and sources and uses. Okay, that's the first thing. Now let's let's change the type of the project. We can change it up here. Let's make it a combined cycle plant because we have a longer construction period for the combined cycle plant. And when we start putting this in, we need to put what our debt size is. Okay, and over here I think we'll put the construction expenditures, the total cost multiplied by our debt percent. You can argue that that's not exactly right, but let's put our debt percentage in. The reason again is if we have interest during construction, that gets added to the size of the debt, and it's going to cause a circular reference. And I'm going to just not put that in this video exercise. Okay. Now once we have the debt size, then let's put our construction percentage. And what we do there is just look at the total amount we're spending on construction over here and just simply divide that by the total. So this would be, I don't know if we have an S-curve or it looks like it's not an equal amount. We might have some inflation, okay? So in fact, why don't we start with this? Let's put the total cost of the plant here. To make the total cost of the plant, I think we can just add the total construction expenditures. So our total debt size is this number. Excuse me. Okay. I'm going to press F4 and multiply that by another F4. Okay. And then we put in our construction expenditure, and the trick here is just taking the capital expenditures and divide them by the sum of the total capital expenditures over time. It looks like we might have some sort of circular reference, but that's no problem whatsoever. Oops. Sorry about that. Okay. These are our construction expenditures, and finally we can get our debt draws. Now once we have the debt draws, we multiply the total debt by the debt percentage, then we can move to the next part, which is the sources and uses of funds. And this is, I've mentioned it a couple of times, but let's put uses of funds, and let's put our debt, capital expenditures, and then we'll put our interest during construction. And maybe we'll just work through the whole sheet right now, and then let's put our sources of funds. And our sources of funds are first our debt financing, and then our equity financing. Okay, and then we'll put a total. So we're really just working through a whole project finance analysis. So once we make the debt funding and sources and uses of funds analysis, the next part is to put a debt schedule together. Okay, and to do that we'll put our opening balance. Now we'll add the debt draws and subtract the debt repayments. Now in this case the debt repayments won't be all that. Oops. I didn't. And then put a closing balance. Once we put the closing balance, we'll put the interest rate, and we can get the interest expense. Okay, and well, let's get the accrued interest. And once we get the accrued interest, let's split it between interest during construction and interest expensed. Okay, that gives us our debt schedule and our sources and uses of funds. Now once we have that, we can move into our cash flow statement and our profit and loss. But before we get the profit and loss, we have to make one adjustment. And that's, unfortunately, we computed depreciation upstairs, but we need to take this depreciation on the IDC. And we can put IDC balance. IDC is, of course, interest during construction. Opening balance, add the IDC, closing balance. Now once we have the balance, then we can get the depreciation rate. Oops. Oh, it's switched to French. And then we can get the depreciation expense on the IDC. And down here, when we have depreciation and amortization, I'm going to rename that depreciation and amortization the base. And let's add another, put less depreciation on the IDC. Okay. And our interest expense, we just have, shh, don't bark. Then we have our interest expense. Excuse me for the dog barking. Ah, tais-toi. Now I'm flustered. Okay. Let's go upstairs and start. I think we can fill this in. Let's just look for a minute at how we computed the depreciation. If you recall, we spent most of the time, and we should have, working through all the 4 revenue components, the A, B, C, D of the of a PPA agreement. Then we had the 3 fuel costs. Of course, there's no revenue offsetting the capacity charge. So the capacity charge covers the depreciation, the interest, well, yes, and the taxes. And then we get our pre-tax cash flow. And I think we did the pre-tax cash flow in the various different currencies. And then we had our depreciation, and we computed our depreciation rate up here. So what I'm going to why don't we kind of start backwards and get our depreciation rate. And can you find the depreciation rate here? Here it is. Okay, so I hope one of the things this does is kind of review a little bit what we did, and then I think we're ready to go. So our capital expenditures, that just came from up here, looking at our total capital expenditures. And then now the interest during construction, what that does, and that's why it's really helpful to work through all the titles. The interest during construction is just the, I'm going to have to paint this. The interest during construction is from below, so we can press alternate equal to get our total. I'm putting our little underlines here. And now the debt financing, that's what we got from just above. Okay. And the alright, and that's I'm essentially doing this to avoid a circular reference. Then we take the total minus the debt. That gives us the equity. And if we use the alternate equal, we're just adding those together again. Okay, so that gives us the total. Now, once we have the debt draws, we can get the debt schedule. The opening balance always equals the last year's closing balance. The debt draws are from above. That's why it was so important to keep those in order. Now, the debt repayments, should have added another line here for this, because what we can do is get the total debt issued and then once we have the total debt issued, get the repayments in a second line, and that repayment will be the total debt issued over the 7-year term. So I just put an equal sign to get the 7-year term. Why don't we, I think, why don't we copy this across? That'll be, I think that'll be useful. And, okay, and then our closing balance is the opening balance plus the draws minus the repayments. Nothing very complicated. Okay, and our interest rate, we're going to get that from our input page. So we put our interest rate here, and our interest rate is going to be the same thing every time. Okay, we could vary the interest rate and get a lot fancier, and then we'll take the opening balance of the debt multiplied by the interest percent. Now, if you look at most of the other models, I put a monthly analysis during the construction period for this reason precisely, because the interest isn't zero in the first year. It occurs over the life. Now, if we take this multiplied by the construction phase, then that's the interest during construction, and that's the thing that goes upstairs into the sources of funds, I hope. So now we have some interest during construction. That will mean our debt, the final debt to total cost will not be 70%, by the way. Okay, now we can take the total debt issued just by accumulating all the debt draws. Okay, that's the total debt we have issued. So after the construction period, it just stops. And then we can take this total debt issued and divide it by the 7, F4, press an F4 on that, and multiply that by our debt percentage, and then we have the repayments over the 7 years. We can put all kind of checks into that, and now I can fill in the debt repayment line. Okay, so the debt went to be 0, which is a crucial aspect of this, and we have the interest. Now, the interest during construction, I could have kind of left this out, but that wouldn't have been really very forthright. And then we just put an equal sign and go up to the interest during construction up here. Oh, I didn't put the interest expense. The interest expense is simply the total interest minus the interest during the construction period, and then the closing balance alternate equals. So that's our balance of our interest during construction, and that has to be depreciated, just like all the other plants. So put the depreciation rate and multiply it by the opening balance. Okay, and then we're finished with our depreciation, and I think we're making fairly good progress because now we can put the depreciation on the IDC right into that line. Okay, and we get our earnings. Now, the one other thing, see, we better also subtract the interest on the interest during construction, and then we put our interest expense as the one we just have from above, Okay, and then we get our taxes and finally our earnings. Now for our cash flow statement, it's really pretty easy. Let's start with our EBITDA. Let's take away the taxes we pay. Now we could take away working capital changes. We don't have any of those, but I'm just going to put those here. In theory we could have them, and let's call that our operating cash flow. Now once we have our operating cash flow, we better, or I can call this cash flow available for debt service. And then we can take away our interest expense, and we can take away our repayments, and then, whoops, I'm running out of space a little, and then we can have cash after debt service. And then once we have that, we can just call that a dividend in a project finance model. Now, there are a number of complications. If you look at some of the other files for project finance, there are all these cash traps and cash sweeps and covenants. That's a cash trap. Debt service reserve accounts. I'm sure maintenance reserve accounts, all sorts of different things we can put in between those. But for now, we're just going to start with our EBITDA, take away the taxes we pay. We could have put a net operating loss, leave that out, so we have the EBITDA minus the taxes we pay minus the working capital. That's our cash flow available for debt service. Let's take away our interest expense and then take away the repayments, and that gives us our cash flow. This is our other subtotal minus this, minus that. That's our cash flow after debt service. And for now, we're just going to call that the dividend. Okay, and the let's put a subtotal here and a subtotal here. And let's copy this across. Now we have, this is really the cash flow statement, or we could call this the cash flow waterfall after construction. Now we can also look at the to get the equity cash flow, and notice we have a space for it apparently here. We start with the dividends, which was the last line of the cash flow statement. And we compare the last line of the cash flow statement with the last line of the sources and uses statement up here, which was the equity financing. Equity dividends is the amount that comes into your pocket. Equity issued from sources and uses, that comes out of your pocket, and then that's our equity cash flow. So we should have called this equity cash flow and IRR. Now I believe, oops, we have a negative dividend. This is a good example of what shouldn't really happen, but I'm going to leave it. In this case, we would have a default or a cash flow sweep, or some sort of other, not a cash flow sweep, some sort of other provision, use of a debt service reserve account, and all of that. But let's take our dividend, let's take our equity cash flow that comes from the sources and uses statement, and the dividend minus the equity cash flow, that's how much we earn. Okay, now with all of the other cash flows, and now we can put the equity IRR in as the IRR and shade the whole thing, so we get a 26% IRR. Now that IRR 26, that was in Naira. Okay. And we might want to also take this IRR and show what the IRR in US dollars is, and then we can show the IRR in real terms, and we better be consistent with what we did before. So to get it in US dollars, we can put equity cash flow in USD. You know, over here this was in mil Naira, I think. Okay. Oops. Not that. This was. Okay. And so equity cash flow in why don't we, you know, to be explicit and to be a little more transparent, why don't we put an exchange rate here just so we can remember exactly what it is. The exchange rate, I hope we can find it here. We had an exchange rate up here and then an exchange rate index. Okay, so in US dollars we have this. Okay, oops. And then so we can get our equity IRR in USD. Okay, and we can then, once we have that, alright, we can then put our real, why don't we put equity, why don't we put our inflation index, and then we can put our equity cash flow real. Okay, and our inflation index, I believe, how did we do this? This is the inflation, you know, and we should be a little more careful. It's good we're kind of looking at this. This is in the inflation index in Naira. Okay, and exchange rate, we should have really said this was N to USD. I hope I did that right. And then we have our inflation rate index, how that changes over time. So we should be very, very careful with all the units. And so our real, since this was in Naira, we'll divide this by the Naira. Then we get our equity cash flow, and we put our real equity IRR, and let's put equal IRR and just shade that line. Okay. So the nominal IRR might look okay, but the real one isn't that spectacular, so it's not that aggressive. So let's put our IRR here and put our real IRR, and then we're essentially finished. And you know, oops, oh, I think I shouldn't have done that. Alright, well, I'll leave that there for now. And then you know, how about this? Okay, so we should be okay. There, I was just checking to make sure the goal seek still works. Okay, and I suppose we should put a sensitivity here as well. excuse me for that. Remember, we put in our capacity charge. Here was our sensitivity, so we really should put that down to 0. Okay, that's that. And I think we better balance the balance sheet. Now we can balance the balance sheet right now by looking at the equity balance. The opening balance of the equity, and just like anything else, equals the closing balance. And then we have our earnings from our profit and loss statement. We have our dividend from our cash flow statement. So our closing, and then we better also add the equity issues. Okay, that comes from either the source. I think it's best to take it from the source and use of fund statement. So there's our equity issues, and our closing balance is our opening balance plus the income minus the dividend plus the equity issues. Okay, and then this formatting, shift control. Yeah, let's see if we put a formatting in. What was our shortcut list? That was true formatting. Shift control D was decimals. Okay, we didn't really put one in for the comma formatting. That's what I was looking for. Okay, and the now this is, let's put our IDC net plant. So we put in our equity account. Now here's the big deal. I suppose this is a good way to kind of explain this. Every single balance sheet account should have already been accounted for. So I'm going to first compute the accumulated depreciation as last year depreciation plus depreciation this year, and then we can put net plant for IDC, which is just the total closing balance minus the accumulated depreciation, and that goes to 0. We can kind of check every single one of these things. What happened to our equity balance? That went to 0. That's really good news. So the IDC net plant is from just above here. Okay, and we didn't put any working capital, and now our total assets. Better add the total IDC. Now on the liability side, we have the closing balance of the debt. This again is this whole idea of finding all of the accounts. Equity, instead of what we did before, we should take this equity. So we take our total liabilities and capital, which is the debt plus the equity, and oh good. So far it looked okay. Let's put a sum on this. Okay, we didn't have any other assets or working capital, but I'm going to leave the space for that and put total assets, total liabilities and capital, and the difference is 0, and we can put a little test, and this is whether this equals 0. Now when you do that, sometimes there's some faults, so what we should do is really put a round of this. We can round it to 2 or 3 places. Okay, and then we use the AND, or the product and make sure that they're all true. And we've balanced the balance sheet, and now we really should be quite happy. And this really essentially completes our project finance model for generation. And we can look and change all the costs around. So remember, you go into the generation assumptions, change all the costs, and change the prices, and we're finished. Maybe I'll compute the levelized price of electricity in the next video. So I'm stopping this and saying goodbye for now.